In this lesson, we're going to learn everything you need to know about T accounts. We'll cover what T accounts are, why accountants use them, debit and credit rules, assets, liabilities, capital, revenue and expenses, opening and closing balances. Full worked examples and common mistakes are made. By the end of this video, you should feel confident answering bookkeeping and accounting questions involving T accounts. Let's begin. A T account is a visual way of recording accounting transactions. It's called a T account because it looks like the letter T. On the left side, we record debits. On the right side, we record credits. Every transaction in accounting affects at least two accounts. This is known as double entry bookkeeping. That means one account receives a debit entry, another account receives a credit entry. The total debits must always equal the total credits. That is one of the foundations of accounting. We use T accounts because they help accountants to organize financial information, track movements in accounts, prepare trial balances, prepare financial statements, detect errors, and understand how transactions affect the business. T accounts are especially important in bookkeeping, financial accounting, adjustments, control accounts, accruals and prepayments, depreciation, and bank reconciliations. Now let's learn the debit and credit rules. The easiest method is to memorize what increases and decreases each account type. Assets. Assets increase with a debit and decrease with a credit. Examples are cash, bank, inventory, equipment, and trade receivables. So if the business buys equipment, equipment account is debited. Liabilities. Liabilities increase with a credit and decrease with a debit. Examples are loans, trade payables, and tax payable. If a loan increases, credit the liability account. Capital and equity. Capital increases with a credit and decreases with a debit. Owner investment increases equity. Drawings reduce equity. Revenue. Revenue increases with a credit. Examples are sales and service revenue. Revenue increases profit, so it normally has a credit balance. Expenses. Expenses increase with a debit. Examples are rent, wages, and electricity. Expenses reduce profit, so they usually have debit balances. Now let's go through proper examples. Example 1. The owner invests £10,000 into the business bank account. Two accounts are affected. Bank account increases and capital increases. Double entry is debit bank account and credit capital account. Assets increase with debits and capital increases with credits. Example 2 is, the business buys equipment for £2,000 cash. Accounts affected are equipment and bank. Equipment account increases and bank account decreases. Double entry is debit equipment £2,000 and credit bank. Equipment is an asset, it's increasing. But cash is leaving the bank account, so bank decreases. Example 3. Make a sale for cash. The business makes a cash sale of £500. Accounts affected are bank and revenue. Bank accounts increases and sales revenue increases as well. Double entry is debit bank £500 and credit revenue. Revenue increases on the credit side. Example 4. The business pays rent of £300. Accounts affected are rent account, which is an expense, it increases, and bank account decreases. Double entry is debit rent expense £300 and credit bank. Expenses increase with debits. Example 5. The business buys inventory on credit for £1,200. Accounts affected are inventory increases and trade payables increase. Double entry is debit inventory £1,200 and credit trade payables. The business now owes money. That liability increases with a credit. Now let's discuss opening and closing balances. An opening balance is simply the amount already in the account at the start of the accounting period. For example, the bank account starts the month with £5,000. That becomes the opening balance. During the month, money comes in and money goes out. At the end, we calculate the closing balance. Example: opening balance is £5,000 debit. Money received £2,000 debit. Payments made £1,500 credit. Total debits is £7,000 and total credits is £1,500. Closing balance is £5,500 debit. That closing balance then becomes next month's opening balance. There are common mistakes people make. Mistake 1. Thinking debit means good and credit means bad. That is incorrect. Debit and credit are simply accounting entries. Mistake 2. Memorizing entries without understanding account types. Always ask, is it an asset, liability, expense, revenue, or equity? Mistake 3. Forgetting double entry. Every debit must always have a matching credit. Thank you for watching. If this lesson helped you understand T accounts better, make sure to like the video and subscribe for more accounting lessons.